A lot of people looking to buy a home in their 30s right now are feeling left behind. Actually, the median age for a first-time home buyer is 38 years old. I was talking with some friends of mine the other day who were like, man, I'm so, like, it feels so strange that I can't buy a home, I can't afford a home, and it seems like everybody else is. And what they didn't realize is that the median age for a first-time homebuyer has been increasing so much over the past couple of years. We can see with this like blue line here at the bottom, and that's because it's getting more and more difficult to save for a down payment. With higher interest rates, that monthly payment for a home is also really high relative to the median income for most first-time buyers. And so, if you're in that spot, if you're in your 30s, you're looking to buy a home, you feel like everyone is passing you by, just know that you are not alone. The median age of a first-time homebuyer is 38. So if you're in your 30s, here's some things that I want you to consider if you're looking to buy. Okay, first, you don't have to buy the perfect home. I really want you to think in terms of stepping stones. So what we mean by that is that your first home doesn't have to be the forever home, right? It doesn't have to be perfect and Instagram worthy and Pinterest worthy. And the trend that I've been seeing is that with social media, we're exposed so much to other people's lives and different circumstances than us. And it makes us feel like maybe we're not keeping up in some way. And what happens a lot is I think online people see someone getting this home that was, like it's the perfect dream home for them. And they're so excited and they're moving in and they're making it their own space. And it can be really easy to feel like you're in a spot where things just aren't really working out for you. And I think because of social media, we've missed out on the concept that most people have with first-time buying, which is that you're buying a starter home. You don't have to buy the perfect home now. I see so many people thinking that everyone is buying this perfect home, not realizing that a lot of those people are maxing out their budget to get this home that looks really nice, when in reality, that's just not realistic for most people. And so it's perfectly fine. In fact, it's the norm to purchase a starter home. And then what you do is you build up equity in that home as you pay down the mortgage. You're probably going to get some appreciation. Your home value is going to increase. And then eventually you can sell that home, have a nice chunk of cash that you can use to purchase a different home. And probably your income is going to increase in that time as well. You might maybe build up some savings, and it's easier to purchase your second home. So basically your first starter home, the goal is for it to fit your needs now, and it's going to build equity for you in the future. That way you can work towards that more forever home, or something that maybe fits even more of your wants and needs in a home. So the goal right now, really, I want you to prioritize financial flexibility over chasing perfection. Again, I know it's so difficult when you see other people posting what seems like this ideal lifestyle, and then it can make us feel really stuck. Like, man, what am I missing out on? What am I not doing that everyone else is doing? It seems like they have what they want. But don't forget that what we're seeing online is this bias, right? People are publishing the good parts of their life. You're not seeing an actual like statistical average of what most people are doing with buying a home. It's okay to buy a starter home, to prioritize your needs right now, even if it's not going to be the prettiest thing, even if it's going to take some work and some love in that home to make it shape up to what you want. Buying a home right now, being able to, again, build that equity in that home, paying down the mortgage, getting appreciation. And then in the future, you can sell that home when you have a higher income, more savings. You have that chunk from selling that home to be able to buy a home that fits your wants better in the future. Really quickly, if you're new here, my name is Kyle Seagraves. I'm a licensed loan officer with NFM Lending, and we help home buyers like you in 49 states, so all states except for New York. And so if you're interested in getting pre-qualified and just starting the next step of seeing what you can afford, what your budget would be, you can go to winthehouseyoulove.com and simply just click Get Pre-Qualified. So you answer a couple questions, and then a loan officer from our team will reach out to you to get you started. That way you can see what types of loans you qualify for, what the monthly payment would be, what the upfront cost would be. That way you can then go prepared with the knowledge, knowing that you can purchase a home, and then you can go and shop for homes if you want to. So there's no obligation with it. It's free to get pre-qualified, and we would love to help you out. Again, go to winthehouseyoulove.com, and we look forward to talking with you. So let's take a look at the math of this really quickly. I'm going to use a calculator that I built. You can go to winthehouseyoulove.com/advisor to be able to use this and do the math alongside me as well. Okay, here's the scenario that we're going to use. I'm going to fly through a lot of this stuff here really quickly, but we're going to use a $300,000 purchase price here. Okay, this might be different depending on the area that you're in or what you're looking at purchasing. We're going to look at using a conventional loan with the minimum down payment, 3% down. We're going to assume the national average interest rate right now is 6.5%. And so what I want to do is we're not going to look at all the loan details because that's not what we're really interested in right now. I want to show you this stepping stone approach and how this works. So let's take a look. Let's consider that you're only going to hold on to that home for 5 years. So you're going to buy the home. This is going to be your first starter home. And then in 5 years, you're going to sell that home and then move into something that maybe fits your needs even more. Or maybe you're working on building a family, okay, and you want a home that's going to be a little bit larger to accommodate that. So we're going to consider selling in 5 years and what those numbers might look like. Well, the historic average appreciation rate over the past 50 years is 4% year over year. So we're going to include that. We're going to include the cost to sell, which is usually around 6% of the selling price. We're going to include forecasting that taxes are probably going to increase each year. National average is 2%. Insurance is going to increase per year. Again, national average of 2% as well. So what we really want to look at here is I'm actually going to scroll down and we want to see what the potential check at closing might look like. So this is all of the factors put together. We're estimating the future of what this would look like as a stepping stone approach to buy your first starter home, sell it in 5 years. What would change in that period of time? Well, that $300,000 home, if it's appreciating 4% year over year, as the historic average has done over the past 50 years, we would see a future value of just shy of $364,000. Now, we would still have a loan balance of $272,000. And it would cost us $21,900 to sell the home. So the estimated check that we could see at closing is just above $70,000, which is quite a bit higher than the minimum down payment of $9,000 to purchase the starter home. So hopefully you can see here, what's happening is the home gained appreciation. It went up in value over time, as homes tend to do historically. And then also we paid down that balance, which is something that when you're renting, you're not able to pay down a mortgage balance. So when you're renting, you're not paying down a balance and you're also not getting any sort of appreciation. But when you own that home, you get to have access to both of those things, which gives you more equity. So when you sell, you have a bigger chunk of cash that you can now use to purchase another home. So you can see owning a home becomes really beneficial really quickly, because if you're renting in that time period, you wouldn't be able to have this amount of money at closing. So using these numbers, theoretically, we could in 5 years sell the home and get a check for $70,000 that you could then use to pay down debt or go towards a down payment on a home. So imagine then purchasing a $450,000 home, a $500,000 home, or whatever fits your needs and wherever you're at, and now being able to put a much higher down payment on that home. So it's still within your budget, but now you've used your first home as a stepping stone to get to your second home. And this is a tried and true method with home ownership, but so many people have forgotten about it. They really just try to get to that max budget and trying to get to the ideal home first. The stepping stone method is a great way to make sure you can purchase a home now that fits your needs and then also get the home that you want in the future. Something else that you can do that we didn't consider in that example is you could also, instead of just straight out selling, you could also rent out your current home as well to help with long-term you getting more equity in that home when eventually you want to sell it. Another thing to keep in mind is that you don't need 20% down. There's still the 20% down myth. You need 20% down for conventional. It's just simply not true. Conventional loans have a minimum down payment of 3% for first-time buyers. For FHA, it's 3.5%. VA loans for veterans, 0% down. And USDA in rural areas is 0% down as well. So none of these loans require 20% down. And so this is, again, when you're thinking about that stepping stone approach, you don't have to go with the waiting years to save 20% down to purchase the home. The goal is to get into home ownership quickly. That way you can gain that appreciation and pay down that mortgage. Also, putting less down can help you keep cash reserves for emergencies or home repairs. For some reason, people assign this like moral quality to having 20% down. You'll see in comments where people are like, if you don't have 20% down, then you should be better at money and you shouldn't be able to buy a house. We don't have to assign some like moral quality to a down payment. When we're actually looking at the numbers, as long as everything fits in your budget, there's nothing wrong with putting 3% down on a home because having that extra cash, not emptying your bank account to purchase a home is a better decision, right? Doing a lower down payment and not wiping out your bank account is a much smarter decision than spending all of your money, spending 20% down on a home, but having zero left over in your bank account is not a smart decision for purchasing a home. And instead of putting all your cash in a down payment, you can consider keeping money in the bank, right, as an emergency fund, or simply investing it for future financial growth as well. So these are all things that you have access to and can do instead of waiting years and years to do 20% down. Now, renting versus buying. I want to be very clear here. I don't think that renting is throwing money away. There's nothing wrong with renting. For a lot of people, renting makes sense. There's a lot of flexibility that comes with renting. However, it's also important to keep in mind that we want to look at the actual math behind these things. And you're paying someone's mortgage either way. You're either paying your landlord's mortgage or you're paying your own mortgage. Okay. So it's not always a bad move to rent, but you're still helping your landlord build equity rather than you building that equity. So we went back to how much you could potentially gain by selling a home in the future when you gain that appreciation and paying down a mortgage. Instead of you having the benefit of that, when you rent, your landlord has the benefit of that. And even with higher interest rates, owning builds long-term wealth and stability. And I'll show you these numbers here in a second. So if you plan on staying in an area for at least 3 to 5 years, buying makes more financial sense in most circumstances than renting. So let's hop back over to this calculator. Okay, so in the same calculator, if we scroll up here, I have a section where we can compare buying versus renting. So let's take a look at this section again, the selling and appreciation. We're still looking at 5 years and we're still making the same assumptions, a 4% appreciation rate, 6% cost to sell, 2% tax increase, 2% insurance increase year over year. Now, what we're considering here is that we gain appreciation. It's going to cost us money to sell the home in the future. We also have the loan cost. So this is things like interest and mortgage insurance. We have property taxes, homeowners insurance. What's not included in here is home maintenance. And of course, you can project that in here if you want to. It's not really something that we can project in percentages. That's why it's not included in here. Some homes, if you're buying an older home, might need more maintenance work than a newer home. So that's something you might want to keep in mind. So when we're looking at this, over 5 years, the cost of owning a home is $88,000, which seems crazy, right? It's like, man, over 5 years, I'm going to pay $88,000 to own a home. I might as well just rent. Well, let's actually go ahead and consider a comparable rental property. Now, what you want to do here is put in a comparable rental payment. Here's the thing that most people mess up when they do buying versus renting scenarios, is that they look at buying a home, so it might be that $300,000 home versus renting, and they don't make comparable properties, right? So a $300,000 home is going to be a different lifestyle quality than renting at maybe, let's say, $1,200. So it's not fair to take your current situation and look at the numbers of a more expensive situation. So let me give you a really extreme example. If I lived at home with my parents, it would cost me $0. Well, I'm assuming my parents wouldn't charge me rent. But let's say I lived at home with my parents, it would cost me $0 per month. Well, if I looked at buying a house is always going to be more expensive than living with my parents, right? But that's not a really fair comparison, is it? To say going from one completely different living scenario to another completely different living scenario. And that's what people do with buying versus renting. If you actually want to look at a fair comparison, an apples to apples comparison, you need to look at, okay, if I was going to rent a home that's going to fit the lifestyle that I want, what would that number be? And then what would a comparable home look like? Of course, you can find cheap rentals in your area, but comparing that to then a home that's going to change your lifestyle, that's not really a fair comparison. So we want to actually be fair with the numbers that we're putting in here. So for instance, let's scroll up here and look at our monthly payment here for a mortgage would be around $2,500 per month on this. All right. So if we were comparing a rental, let's assume that even we found a rental that would be somewhat similar. Maybe it's the same beds and baths, maybe somewhat similar square footage. Let's say we even found one at $1,750 per month. Okay. Now, rent is usually going to have rental increases year over year. The national average is 3%. So that's factored in here as well. So again, buying that home, that cost over 5 years is $88,000. However, renting, that $1,750 per month with a 3% increase year over year is going to be just shy of $112,000. So even though this seems like a crazy number, renting is still a more expensive option than the cost of purchasing that home. Okay. So that's the big thing that you want to consider when you're comparing renting versus buying, is an actual true apples to apples comparison, and then run these numbers to see what it would be like. And it's really interesting to see that, yeah, even though you're having that higher monthly payment, the difference here is that you're getting that benefit of appreciation and also paying down that loan balance over time. Okay, also at this stage, you want to plan for family growth, even if you're not sure yet. So if kids are in your future, or maybe you have kids now, think about extra bedrooms, school districts, and the resale value of your home, right? Those are really good things to keep in mind. Even if you're not 100% certain, it's easier to be able to lock in a home now in, for instance, a good school district that you know you would want your kids to be in, rather than having to move later on when you're like, okay, now we need to consider things like school districts. If not, though, if kids are not in your future, then focus on things like the location, lifestyle, and investment potential of the home. So for instance, think about your lifestyle and what you want. Are you going to want to be closer to a city center, for instance, rather than having more space, or a yard or things like that? Flexibility here is key. So your life is going to change in ways that you probably don't expect. And so it's good around this stage to start thinking about those things of, okay, if you're looking at that starter home, yeah, it's good to try to find a good deal, but also keep in mind, if you're wanting kids in the future and you don't want to have to move anytime soon, okay, then you might want to keep in mind things like school districts as well. Another big tip here, I know a lot of people don't love this. I know, I get it. I absolutely want to be able to buy a home wherever I want and for it to be affordable. But with the state of the housing market right now, that's just not feasible in most areas. And so for a lot of people, if you extend your commute, often you're going to be able to find a home that's going to be more affordable while still being relatively close to your work. Okay, so homes closer to city centers are often going to come with higher prices. And a lot of people are going to work in those cities. And so, of course, you're going to find higher prices around where most people have jobs. So if you're willing to expand your search radius for a home by 10, 30 minutes, some people are even comfortable with going up to 45 minutes to an hour commute. It could mean that you could have a more affordable home, something that fits your budget a little bit better. And you could even look at things like a USDA loan that does 0% down, has lower interest rates and lower mortgage insurance as well. And so again, sometimes extending your commute by maybe 30 minutes rather than being 5 minutes down the road, 10 minutes down the road. If you were 30 minutes, 45 minutes down the road, I know that's not ideal, but the goal here is we're building that stepping stone approach, right? We're making compromises to make things work. And it might even open up access to different loan types like USDA that might make more sense in your budget than a traditional loan. And balancing your commute time with affordability can help you find a better long-term fit. Okay. Again, the goal here with what you're buying is not find the perfect situation where everything makes sense. It's making compromises that fit with your budget so that it aligns with your long-term goals. Another thing that's not exactly home buying related, but a big issue that a lot of people are running into as home prices continue to increase and interest rates with where they're at, it gets more and more difficult to save for the down payment, to find a home that's comfortable within your budget. And frankly, what a lot of people need is a higher income. So getting a higher income is going to make it easier for you to save for that down payment and to find homes that fit in your budget a little bit better. And job switching is the quickest way to get to a higher salary. So switching jobs strategically in your 30s can increase your income faster than waiting for small raises. There's a lot of studies that you can look up on people who do switch their job, and most people who job switch do find higher incomes. It's just an easier way to be offered more money than staying in the same company. I wish it didn't work that way, because I'm sure a lot of employers would love for you to stay, but that is something that you might want to consider, is starting to look at, okay, if you want to start getting more serious about purchasing a home, that might include needing to increase your income. And this can be a really great strategy for you to do that. So higher salary is going to mean more purchasing power, the ability for you to get a larger loan if that's something that you want, and better mortgage options, since you're not going to be limited by potentially higher debt to income ratios that can restrict the type of home value that you can afford. One note here, though, is that lenders prefer stable job history. So moving to different jobs is completely fine, but it's just something to keep in mind where you don't want to completely change your income type, for instance, from a salary income to commission without talking to a loan officer first, because things can start to get a little bit tricky and you don't want like a clock to reset with your income. So if you are considering making like big job moves, it might be worth talking to a loan officer first, just to say, hey, how would an underwriter perceive this before you take a job switch like that? Another thing to consider is house hacking to offset your mortgage. House hacking is basically just using different strategies to try to get your mortgage paid down without just you paying the mortgage. So one thing that you can do is you can buy a multifamily home and rent out the other units. So with things like a conventional loan, you can actually buy a 2 to 4 unit home with only 5% down. With FHA, you can buy a 2 to 4 unit home with 3.5% down. So you would live in one of the units and rent out the other units. That can be a really great strategy. Another option is to rent out spare bedrooms or a home that might have a basement apartment to help cover your mortgage. Again, I know that doesn't fit everybody's lifestyle. Some people don't want roommates. You might be in a relationship and, having a roommate doesn't make sense. Perfectly fine. These are just options that can be really helpful. I think a lot of people forget that these are options, right? You can buy a home and it doesn't mean that you have to be there by yourself, especially if you are a single person. It's fine to have a roommate, right? It's not a failure to purchase a home and then to have a roommate. It doesn't have to be all by yourself. These can be really great options that I think a lot of people just forget, again, because we see so much on social media about everyone's having the dream home purchase and everything is working out for them. It's okay to find different options that work for you and your budget. Another thing to keep in mind is a lot of people are waiting on interest rates. The assumption is that, okay, interest rates are going to drop back down to 3% and then it's going to be easy to purchase again. And it's very unlikely that we're going to see 3% interest rates again. That was a very different time in the market than it is now because we had the Federal Reserve purchasing billions of dollars of mortgage-backed securities, and we're just not in a market like that right now. So what's currently happening is that a lot of buyers are holding off, hoping that rates are going to drop. The issue here is that there's so much demand for housing and so few homes available. That's what's keeping home prices up currently where they're at right now. That's why home prices have increased so sharply and are remaining where they're at, is because there's a ton of people wanting to buy a home and there's not a lot of homes available. And so those prices are going to go up. The problem is that when rates go down, so let's assume that rates go down significantly, it's very likely we'll see home demand increase, and there's already a limited amount of homes available. So that's going to increase home prices and can actually make the affordability decrease. It actually is going to be more difficult to afford a home because of those home prices going up. You're going to have more bidding wars for homes as well. And that's all banking on rates going down. Right now, with the uncertainty in the economy, it's very unlikely that we'll see rates go down so sharply that it's going to offer this massive relief for a lot of home buyers. Something to keep in mind too is you absolutely can refinance in the future. So for instance, if you buy a home now and your mortgage rate is 6.5%, and then in the future the rates go to 5%, you can refinance your mortgage down from 6.5% to 5%. However, if the home prices have increased, you can't go back in time and buy at today's prices. So that's what happened a lot over the past couple of years. We saw home prices increase and we saw rates increase. And what I saw a lot of people do is they were like, well, I'm going to wait for it's certainly going to crash. Rates are going to come back down. Home prices are going to come back down. And it didn't. And home prices continued to increase and increase and increase. And a lot of people got priced out of the market where they could have bought at that time and secured a good rate and a good home price. But then things continued to increase. And then they were priced out of the market to not be able to afford where they're at today. And a lot of people have their own beliefs about what's going to happen with the housing market and home prices. But what we can't ignore is that historically home prices have continued to increase year over year. And when there have been dips in the median national home price, what we've seen is a couple dips. There's been a couple dips that are 3 years. So if you bought at the height of that period and then it dipped, and within 3 years, the median home price went back to where it was at the height. And even in the 2008 housing crash, if you bought at the height of the market then, If you waited 6 years, it would have been the same home price if you sold it within that 6-year period. And so a lot of people have this fear that they're going to buy at the wrong time and then they're going to be forced to sell it in the future and they're going to lose a ton of money. But historically, we just don't see that to be true. Anytime there's been those dips, again, if you bought at the height, the worst one in 2008 was a 6-year waiting period to get back to the home price that you bought it at. So the goal for you, I want you to buy smart and not just buy fast. I know it can feel really easy to see everyone else purchase and feel like you're left behind. For some people, what they do is they freeze and they just say, well, I'm just giving up on the whole thing and I'm not going to buy a house. It's all a scam and it's all made up and it's, never going to work for me because of X, Y, and Z reason. And for other people, they're like, well, I have to get in now. And then they make decisions that they're going to regret because they're based on emotions and they end up maxing out their budget and they take on more than they can afford because it seems like that's what everyone else is doing. They're getting these homes and I have to keep up with them. And so in this spot where you're at right now, in your 30s, there's a lot that you're probably figuring out, a lot that you're figuring out emotionally about your financial situation, about what you want to do in life, where you want to be, who you want to do it with. And so there's so many decisions that you're making at this point. And I want you to keep in mind that this is a long-term decision and it's not a race. I don't want you to feel left behind. Again, remember, the median age of a first-time home buyer is 38. So it's okay if you don't have it all figured out right now. The goal is, what do you want your life to look like over the next 5, 10, 20 years and beyond? And start making decisions right now. That way, when you're at that point in the future, you can look back and say, okay, I did everything that I could to prepare myself for where I'm at currently. All right. So focus on your goals, the goals that you have right now. That might include not buying a house. For some people, it might be, I'm actually going to downsize and try to, maybe I want to travel more. And so maybe a home isn't in your future with that. And that's perfectly fine. For other people, it's, you want the house, you want the dream job, you want to raise a family. If so, focus on those goals and what you need to do now to set yourself up for that in the future, because you don't have to make it happen right now. We can make it happen over a longer period of time. And try to ignore this external pressure. If you need to unfollow people, if you need to tell Instagram to not suggest you accounts or whatever you need to do to block out all of that pressure that is pushing you away from your goals and the things that you want to do in your life, make sure that you do that. And whether you buy now or later, making an informed decision is going to set you up for success. Really, I think that the more calm you are, the better you can get to a calm state, the more clarity you can have about the decisions that you're going to make, not only with buying a home, but with every other decision that you're going to make in your life.